Good day, everybody. It's Greg Schnell, and I am here with the market roundup for May the 18th, 2019. The days keep humming along, and we have a pretty interesting market with lots of things shaking it up. U.S. dollar breaking out is probably the thing I'm noticing the most this week, but let's get into the agenda here, and I'll show you what I've got. First of all, we had lower highs, lower lows, and a lower close 2 weeks in a row, so that's probably definition of a downtrend. So let's keep watching that. The Russell and the NASDAQ underperformed. Neither one of those are promising, so that also adds to my bearish sentiment. We've had more distribution days, including today for the NASDAQ, so that's another one. And options expiration was today, was Friday, May 17th. So that's a big issue here. And what we're watching for is after options expiration, I usually find the market will kind of pick its a different directions. Or if it was going to pick a different direction, this could be an inflection day. So that's what I'm watching for early next week, say Monday, Tuesday, Wednesday. Not necessarily right on Monday morning, but sometime over the next 3 days, we start to see price action move one way or the other, and I would expect if it was going to be moving, it would be down. Oil holds up, but lumber tumbles. And the problem with lumber that I see is that it's falling. Actually, it had a very weak week, and so that's not good. Next is the financials, and they really were not great. I've written a Chart Watchers article for the weekend here, and in that Chart Watchers article, I just made a list of a lot of the financials, the big banks around the world that are very close to new multi-year lows and breaking down quite hard. Now, some of them are just making 2019 lows, but when you compare that to the S&P up 25% and you see these banks making new lows, that's a big deal. And so the currencies also had some big moves in both the Aussie dollar, the British pound. So we got lots to cover off. Let's shoot right into it. This is just a view of some emerging markets or not emerging markets, some country currency or country charts priced in US dollars ETFs. And this one on the left is the Canadian dollar, or the Canadian market. Sorry about that. The Canadian market. And the one on the right is the Swedish market. And I like to watch the Swedish market because I find it's a long story, but anyway, one of the things I noticed is the Swedish market might move a couple of days before some of the other markets, and so it's sitting right on its 200-day moving average, so wouldn't you know, no real data. The Canadian market is sitting on its 50-day moving average, and the industrials in Canada look a little better, but there was a couple of big mergers in there. We had a privately funded buyout of WestJet, and then we also had Air Transat getting looked at. So a lot of consolidation in the airlines in Canada, and that was pushing up some of the industrial indexes. But the big thing that I think is important, if we just look at this black line, which is the 40-week moving average over a 3 or 5 year period here, whatever we 1, 2, 3, 4 year period, you can see this rolling moving average, and the Swedish market got up and has literally, pushed down for 4 weeks in a row. We've got red bars, full stochastic dropping. We haven't quite got a sell signal on the PPO weekly, but it's pretty messy. And you can see the relative strength is broken down significantly. In the Canadian market here, you can see that we're still up near the highs, but again, our full stochastic is turned down. Haven't quite got a sell signal on the PPO, but again, I think those two mergers probably make up for a lot of the, for one of the reasons the candle didn't go red this week. So anyway, just something to watch for. I want to cover off the S&P sectors here. And one of the reasons to cover it off is you'll notice that this is over the last 20 days, and look at the defensive tone in the market, the financials being flat compared to the S&P 500. And if I toggle that off and just say what was the actual change, the financials are down about 1% over the last month, and you can see that the defensive tone of the market is pretty high, and the offensive tone of the market, or the growth tone of the market, is very weak. And so everything from in the materials, from lithium to gold, silver, really getting hit quite hard. And the industrials in the US have now moved below their 10-week moving average and look like they're going to go down and test the 40 weeks. So we'll get into that chart. The only thing that's still holding up over the last month is the communication services, and that's pretty marginal at best. So it has been a defensive tone to the market, and it really does seem to be picking up steam. So we want to keep watching where the money's moving into, and at this point I'd say it's clearly focused on the defensive side. Okay, let's jump into the charts. So breadth here is breaking down again, I think. So here we have the advanced decline line, and let's use this orange line for the NASDAQ. And we've got this uptrend. The slope of this orange one more closely matches these two trend lines over here. This red one was a little more upright. So with a lower slope, and we're still breaking down here. We did go negative on using kind of a moving average because the data swings a lot. And again, we still kind of have the top marked here that after these tech companies reported earnings, the NASDAQ, even though they had good numbers, the NASDAQ really wasn't able to do anything. So that's one of the reasons that I continue to be cautious towards the big stuff. The NASDAQ high-low, clearly not doing very well. We got a little bit of a kick off it, but again, back below zero here on the Friday. So not that good. And again, the moving average of the high lows, you can see we're back below zero, and you know, it can dip down here, and it still means we just need to watch it. The big thing for me again is that we just never really got a lot of breadth, and now we're starting to break down. On the New York Composite, the advanced decline line, it's just jogging sideways for 5 weeks. While it's broken the uptrend line, it doesn't really seem like it's broken yet to me, but it is, you know, we keep making lower highs on this, and this index is down here at 8, so pretty much zero. So this continues to be another data point that's a little bit weaker. For the New York Composite high-low, what you see here is we got back up to this 100, just really didn't do anything, and we had 32 to finish the day today, so that's pretty weak. Let's go down to the Alexander Elder method of looking at the high lows, and you can see that we're at 95, but in this bump here, what he did was he summarized a 5-day period. And so with this, you can see that getting up to 1,000 wasn't really that bullish compared to some of these other big runs. But now we're sitting right here at 95. That's pretty minimal. And so you see this little blip here in September, so that would be something I would be concerned about. I don't feel like we have enough momentum based on quite a few things. So here's the McClellan oscillator, down 25 on the day, and we're at 600 on the summation index. Again, market usually breaks down hard when it goes below 400. We're still holding above 400, but you can see we've dropped a long way. So since the beginning of March, we were up around 1200. Now we're at 600. And back here in September, we started to break below that 400. So that's kind of the area I'm watching for, is this 400 to really give me a sense if this is going to break down hard. But without question, since March, the McClellan oscillator has been living below zero. So it definitely does add up to be a little bit of pain down here. The NYSE summation index just shown differently, going back to 2004. And the only thing I'm showing here is that we had a big strike up and a big strike up and then kind of a wiggle down. We're now on that wiggle down. And that marked a pretty meaningful pullback back in 09. So maybe we'll see more of a pullback here. But you know, are we in this stage where we're coming out of a big bear market low and we're about to bounce up, or are we just getting started like 07 or 08 and this is rolling over? So that's kind of what we're checking for. Now, for the bullish percent indexes, I think one of the biggest things I'm not happy to see is that for the NASDAQ, we have only 50% of the stocks on a buy signal. So just in general, if you only got half the stocks on a buy signal, that's pretty darn weak. And this is after a big rally where we went up and made new all-time highs, and we could barely get above 55%. So most of the big tech companies doing the heavy lifting, but the rest of them not doing much. And the percentage of stocks above the 200-day moving average, we're down to 43%. That's pretty low. Hard to expect a big bull market with only 40% of the stocks above their 200-day moving average. So for the broad index, that's a problem. Now, I covered off some of this on my market buzz on Friday morning, so I don't want to dwell on this, but here's the NASDAQ, or the New York Composite. The other one was the NASDAQ Composite. And here we have 54%, but we're making lower highs again. And we never did get more than 60, which is still, in my opinion, a little too bearish. And then down here, we only have 53% of the stocks above their 200-day moving average, and that's down from 65 just 2 weeks ago. So market pulling back pretty hard here, and the breadth is really narrowing. And obviously, if you get less than 50% of the stocks above the 200-day moving average, you're probably in a downtrend. So I would just say we're at the most, we're hovering, that's all. And with 55%, that's an important level. But, you know, even if it got below 50, I think we'd still want to be very aware. You can see back here in the early January 2018, when we fell down here, we got down to this 50 level as support. Well, we basically didn't do anything but get to 60% all through to September, and now we're at 60% again, and we're already rolling back over, and now we're making lower lows. So it looks to me like the breadth is leaving this market quite quickly, and I still think our next big move is down. So for the S&P 500, we're at 60% of the stocks are above their 200-day moving average, and you can see in September we fell from a lot higher level, and in January of 2018 we fell from a lot higher level. So I'm really not, you know, I don't have a reason to be more bullish here because we don't seem to be expanding in breadth or anything like that. The percentage of stocks above the 200-day moving average is down to 60%. We were at 72% 2 weeks ago. So this is quite a dramatic fall. You know, almost 20% of the stocks that were above their 200-day moving average are no longer. And lastly, let's go do the the NASDAQ 100. And of course, this is the giant tech companies for the most part. And what you see here is we were at 85% or 84%, and now we're down to 54%. So this is like massive. 30% of the stocks in the 100 out of the 100 have dropped. Not only are they not breaking out to new highs, they're now making lower lows. So that's a pretty big change, and the bullish percent index is really meaningful that way. Now you can see back in 2016 we kind of had those wobbles as we came off the market low of early January 2016, and then in October we had a big pullback, and that pullback was quite noticeable. It's hardly a ripple on the pail here, but what we're looking for is, you know, what's going to drive the breadth higher. And I think the big concern for me here is we just haven't had enough stocks participate. And again, the percentage of stocks above the 200-day moving average is down to 63%. So 2/3 of the group are still above their 200-day moving average, but this is really out of the top 100. So hardly, not great that we've lost so many of them already from 75. Okay, let's get into the options expiration. And I think the big thing to remember here for options expiration is, you know, if the market was going to break down, this is kind of the place I'd expect it to do it from. Maybe we hover for the next couple of days, and then it would probably be the move down, is kind of how I would expect it to go. Doesn't mean it'll go like that, but you know, it's something. So back here in October, we kind of wiggled down, got to options expiration, and then we started our move down, had a few days of rally and then moved down, and a few days of rally and a move down. So that's more what I'm expecting, is probably something similar to last October. For the Fed meetings, so again, the Fed meeting still marked the single market top, and we've fallen for a couple of weeks since then. And this brief rally in here for the last couple of days um, has helped, kind of knocked off an oversold condition. We didn't have a lot of volume on the S&P 500, even though we started off the day trying to rally. So nobody was interested in buying, it seems. So at this point, it wasn't. It wasn't a high volume day. And for options expiration, that's kind of a surprise to me. Um, on the monthly performance, what we see here is we're down about 1.5% over the month. And on the year-to-date performance, we are still at 14%. Now, this blue line here represents the market top back in 2018 in the January timeframe. You can see this right up here. And so we have this sitting here, and now we're kind of bouncing off that level, and it looks to me like we're reversing. So we'll see if that's the way it works out. But notice how quick the market fell through this level back here in September, October. It was kind of this level that it couldn't get through, and when that support level didn't hold, down we went. So keep watching. I think the markets are set up a little risky here. Okay, let's look at the outside bars. So what I like to do is just keep track of how these three markets move together, the S&P, the NASDAQ composite. So this is kind of large caps. This is kind of a summary of a lot of stocks, and then the small caps. And what you see here is lower highs, lower lows, lower highs, lower lows, lower highs. Last week for the Russell, it had made a higher high and a lower low, so we call that an outside bar. And then this week it's a lower high and a lower low, and we closed below the last 6 or 7 weeks. So that's pretty bearish. And then here on the NASDAQ, we closed at new 5-week lows, so not very good either. And on the S&P here, we closed at new 5 or 6 week lows. So nothing really popular on any of those charts. For the NASDAQ distribution days count, so again, a distribution day, and this was from William O'Neill, a distribution day is a higher volume day on a down day. And so the volume candle would be red, and so what we just want to look for is a red candle that's bigger than the candle the day before. So this is not a distribution day. This is 1, this is 2, this is 3, this is 4, this is 5, and this is 6. Now, normally with Investors Business Daily, what he would always look for is, does it have a significant move associated with it, or was it just kind of down marginally? I think that Monday was a pretty big down day, and today again we lost another whole percent. So those are meaningful moves down. Look at where the PPO is; it's below zero. The last time we went below zero, we were in early October. So I just don't get the feeling that there's a lot of momentum here, and again, it makes me a lot more worried about the overall condition of the market. From the NASDAQ weekly, it still looks okay. We're holding above this red line, and we've just gently had 2 days of pullback. We don't have a PPO downtrend. But again, it's all of those other bread things that make me more concerned. So here's the New York Composite, and again, this chart I find is the first one to kind of break down. So I at least want to be aware that this one is breaking down before I expect the S&P to break down. And what you can see is so far this month, it's down about 300 or 400 points off the close of April. And this pullback here, we're still above the 10-month moving average. But again, we still have this series of lower highs going back to January 2018. And our momentum indicator continues to drift lower. So on a monthly chart, even though we've had this big spurious rally for 4 or 5 months, it hasn't done anything to kind of improve the momentum because we're still making lower highs and lower lows. Now, this 10-month moving average is a pretty important thing for all of us. It's roughly the 200-day, not quite, but close enough. And the 10-month moving average is, we're just barely sitting above it. So what do we got? We got 12,550 and 12,650. So we're roughly 100 points above the 10-month moving average. And at this point, the 10-month has started to turn down again. So watching this very, very closely, because obviously a downtrending moving average is not that strong. Okay, looking in on the Russell, this is one of the ones that really starting to concern me. So after Russell broke through this 1600 level and we were all bullish, we closed up there on a Friday, it opened the next week and that was down hard. Then this week we opened down hard and we didn't really recover. We're back below the 40-week moving average, which would be equivalent to the 200-day or the 10-month moving average. So just to keep it all perspective, it's a monthly chart is 10 months. Weekly chart is 40 weeks, and a daily chart is 200 days for roughly the same moving average. Now what we see here is the relative strength starting to break down on the Russell compared to the S&P 500. And what you'll notice is back here in September, we also started to see that trait. And then in November, when the market sold off quite hard, we saw that trait. And then we had a brief rally off the December lows, and the Russell started to outperform heading into that low. And then we rolled over in March, and you can see the Russell underperformed for 3 or 4 weeks there. And then it took whatever 8 weeks to get back to the prior high. We broke out for a week, and now we've given it back up again. So to me, this looks too weak. I'm not happy with it. And as you can see, the Russell is now near 3-year low. So everybody's moving into the large cap for safety, and the real question is, will they find it there, or is the global weakness too much? Now, if you notice the Russell here, look at the size of the move down on the PPO. The histogram, they got a lot closer together, so we were gently going lower, and now all of a sudden we're gapping lower. And we clearly are rolling over on the PPO. The real question is, do we roll over, touch, and take back off, or do we roll over and break down? And again, being right near zero here, this is a very concerning place to roll over. So back in middle of 2016, we had these same kind of weaves, and then we took off to the upside. So that was pretty positive. We had a lot of kind of rough water to get through for a few months there, and it went up. Here we've had the same sort of rough water, the same sort of weaving. So now the real question is, can this start to turn higher? The difference, if you'll notice in here, was the Russell kept outperforming and making higher lows. Here we're making lower lows. So not that comfortable. Okay, just real briefly on the Canadian market, the reason I want to mention that is, it actually was down 0.5% this week, or 0.25% this week, not that big a deal, and a little bit of a pullback. But what you'll notice on the chart in general is our PPO is down below zero as well. The last time we got there was August, and the Canadian market broke before the US market. So watching this wobble here around the 50-day moving average, and if this is going to roll back over, that's a problem. Okay, the Shanghai. So China's been in the news quite a bit lately, and what we had was the tariffs announced last week, and this week we made a lower open. We tested higher and closed right near the bottom of the bar. We actually got a sell signal on the PPO on a weekly chart rolling over, so that isn't very bullish. The Nikkei, really an odd week for the Nikkei. It actually had a big day on Friday, up day, while everything else was down. So quite odd. But again, this 21,000 number, I think the central bank in Japan is going to defend that level over and over and over again. Going to try and hold the market above that, because I think if this starts to break down again, that's a pretty big deal for them. Anyway, relative strength dripping to new lows here, and of course it bounced up as they had an up day and we had a down day, so that means its relative strength improved, so that's why it ticked up. Here's the US dollar, and what we see on the US dollar is it continues to push higher, and if we just look in on the zoom panel here, this is the highest close we've had. So we're starting to see the dollar break out above these prior highs, and so we had pushed up and broken above 96.5 right about here. And when we did that, then we pulled back down, made lower high, lower low, lower high, higher low, and now we've made an outside bar on the US dollar, which is usually considered a reversal bar. So you test lower, you get back above the lows, then you get back above the prior highs, and you close above all of that. That's a huge bullish outside bar. And if we did that in a candlestick form, let me just change that, whoops, so that you can see that. So you have this big white candle here with buying tails all below here down at around the 97 cent and taking off to the upside with the highest close going forward. So this is clearly very bullish, but the big thing that happened was some of the other currency markets also actually made big breaks down, and Australia was one of those. And Britain was literally dropping every week or every day this week. So big moves there. And here you see the PPO on the US dollar. It's been gently sloping down, but it looks to me like we want to turn and start to go through here. And if we get a sudden move on the US dollar, I think that would probably be a big clue that there's something going on. Okay, here's the US dollar on a bigger picture. This is the Martin Pring sort of chart with the special K. And we're breaking through this downsloping trend line. We're above zero and pushing higher. So all of this suggests to me that the US dollar wants to go higher. It's fighting this 97.5 level aggressively, but I think it's going to end up going right through that. Okay, daily chart of the US dollar, and what we see here is the same sort of thing. We had an uptrend in momentum coming in here. We're turning up. We got a positive PPO cross today, and it looks like we're breaking through this downtrend in momentum that's almost a year long. And so to break through this and start to pop to the upside, I think this is kind of the move that we've been expecting in the US dollar, and this is another reason why I think the rest of the world is going to slow down a bit more. Especially emerging markets, they're more commodity centric. And so if commodities are pulling back, that's not good for them. And their currencies drop, so that makes it harder for them to buy things. And if the US dollar goes on a bit of a run here, that just puts pressure on everything. So bigger deal for emerging markets, and that's one of the things that seems to be playing out here. This is the UUP, so a way to watch the US dollar intraday. And what you see here is trying to push up, and it did close at its highest high on this chart as well. And from a momentum perspective on the KST, again, we got into this fine oscillation here where it was really didn't know which way to go. And I would say the same thing on the dollar here. Look at how tightly wound this is. And now all of a sudden we're getting our turn up on the PPO, and it looks like it's ready to surge higher. So as the US dollar breaks higher, we're seeing the S&P kind of break lower. So that's a little bit of a concern. Okay, on the euro, so this is a weekly chart, and again, we talked about the positive outside bar on the US dollar. Well, on the euro, we had exactly the opposite, and we've had outside and inside bars lately. So last week was an inside bar on the euro, and this week was an outside bar on the euro, where we made a higher high and a lower low and a lower close near the bottom of the range, which suggests weakness. Now, from the PPO perspective, we're pretty much flat, and the histogram says both the signal line and the price line are about the same place. But the point I want to make is you can see that this euro is starting to drip and almost a little bit faster here. So we'll keep watching it. But again, I like to keep track of the Swedish krona, which is this one. And the Swedish krona is clearly drilling. It started to break down hard, and this looks a lot more aggressive than what we see on the euro, but I think it's telling us which way this market wants to move. And the krona closed on its lows. The PPO is breaking down, so I'm expecting more pain in the euro coming out of that. And I think the euro chart's telling us the same thing, right? We had a big down thrust. Here's the daily, but look at this move down all week. So while the US dollar was working its way higher, the euro was weaker, and the DAX is trying to hold around this 12,000 level, which is important. And maybe whether you use the 12,000 or the 11,750, we're in the range here where this market could break either way. So watch that closely. Okay, looking in on the British pound, it had a big thrust down this week. Look at this big bar. So after an inside week last week, literally dropped and came all the way back down, and we've got this 3-year trend line sitting here, and it looks like it's going to test that. But based on the way it closed, like literally slamming onto the floor on Friday, and the PPO rolling over on this weekly chart at 0. This looks to me like it wants to go a lot lower, and I wouldn't be surprised to find this big uptrend and momentum break, and as the currency's breaking here as well. So I'm expecting lower prices for the British pound. Here's the British pound on a daily basis, and look at this. Just straight down. Nothing really going on, no defense of it. And so we made our high roughly May the 3rd or something, and big outside bar only to reverse and literally take it all the way down the other way. Looking at the yen, so the yen just continues to work me. I'm trying to figure out which way it wants to go, and again, it just keeps grinding for this whole year so far. But the yen made a higher high this week, a higher low this week, but closed down on the week. So you can see, come on. So you can see that here's the last week's close. This is this week's close. So closed down slightly, but this bar is still bullish because it made a higher high and a higher low. And let's just call it relatively unchanged on the week. Okay, bigger picture for the weekly is you can see this downtrend line going on for 3 years, an uptrend line going on for 4 years, and which way is this going to resolve? It just keeps getting narrower and narrower. The PPO is turning up now, and so this upturn on momentum is a clue, and usually if the yen is rising, that's usually when we have commodities correct. So rising yen would be rising yen would see gold follow it higher. But again, we don't have a direction yet on the yen, so we'll have to just wait and see. Canadian dollar didn't do much with all the mergers and that type of thing this week. We made a lower high, a lower low, and a lower close. So nothing really bullish on the Canadian dollar. Australia, this one. So we talked about it last couple of weeks how it was just trying to hold this 7 level. Well, this week it literally let go. We made new 3-year lows, and now the only thing holding us up a little bit is this 2016 low. And if we just take this chart and run it back, you can see we'd have to get down to the 09 lows for the Aussie dollar. If this 2016 level goes. So not a lot of support below this level. If this thing starts to drop, it would be moving to new 9-year lows or whatever. So keep watching that, but a weak Aussie dollar probably isn't that helpful for commodities. Okay, emerging market currencies, these things are rolling over hard, so nothing really comfortable there. And again, took a few months here for momentum to wane, but now it seems to be clearly in a downward path. I've got the price of copper behind it, and copper's telling us the same thing. So it looks like the emerging markets want to break down. Okay, the bond market, quite a rattler going on here. So here's the high yield, and it's breaking down below the 10-week moving average. Again, this is unadjusted. I've taken the yield or the dividend payment out of it. So breaking down here below the 10-week is a little bit bearish. It would be more bearish if it goes before this 40-week moving average. The 7 to 10-year ETF for Treasury bonds heading higher and making a higher high, closing on a higher high. So this is clearly going up. People are still buying the bonds. And for the HYG, so the high yield versus the 7 to 10-year bond, what we see here is a big move down and a rejection at the 40-week moving average. And we saw that same thing back in 2015 and the rollover. So bonds this ratio made lower lows this week. And again, that's bearish. So, so people leaving risk and going to safety, that's why we call it bearish. Okay, I don't want to go through all of these bond charts. There's so many of them, and they're all telling us the same thing, that bonds are being bought. Here's the municipal bond fund heading higher. I think it's this ratio of the bonds to, here's the 5-year to the 30-year. And again, if for this ratio, what we should see it load a little quicker. Let's try that again. There we go. Okay, BlackRock Community Fund. Let's go down to my ratio. Here's the 5-year to the 30-year. You can see we're sitting right on this trend line, and I think this is the line that I want to watch for. And if this starts to break, and that would be a big deal. So again, the spread between the 5-year yield and the 30-year yield, and on this chart here is the 10-year versus the 30-year, and it's not quite as close, but it did pull back for the last couple of days here. So continuing to watch this trend line, and I think the break of that trend line would be a significant note to get extremely cautious. But we're not quite there yet, but there's lots of reasons to be concerned. The transports closed down below both the 50-day and the 200-day moving average on Friday. After a brief rally of a couple of days, fell down again, so that's not great. And looking at the weekly chart, this is rolling over right at zero for momentum. That's kind of what we'd expect. Well, not what we'd expect. If we get a rollover at momentum in a near zero here, this is quite bearish, and we could expect probably weaker levels to show up. Airlines, nothing really going on, chopping sideways, so we'll just forget that chart. Let's go to railroads. Railroads had an interesting day today. They had an inside bar, so higher low than yesterday, and a lower high than yesterday, and a lower close than yesterday. So just wobbling in the middle. Momentum is still okay, but we do have some negative divergence where this wave is lower than the previous wave, even though price is higher. So I still don't think the railroads are that bearish, but I don't want to see this upsloping trend line break, which pretty much goes back to, 5th of January or something like that. Trucking, real quick, it's trying to hold this level for obvious reasons. Momentum's right at zero. We'll keep watching it, but the trucking companies have been giving disastrous look-aheads from their earnings calls. So not good. Tesla had another bad week, and that's pulling down the autos pretty hard this week. Rolling down, the 10-week is below the 40-week, price is below both of those, and threatening to take out the 2009 low. So not a lot of hope for the auto business, and it looks like it's rolling over on the PPO. We got a negative histogram here, so that just says avoid, and I'd recommend that as a good idea. Here's the broker dealer, and it is really trying to hold this trend line. That's kind of an early warning group. Broker dealers usually do pretty well, and with all the IPOs, you think they'd do great. But this looks to be rolling over. We got our first red candle this week that we've had since early April. So keep watching, but I don't want to see that trend line break, and that would be another clue that the market's getting weaker again. Utilities actually performed well, highest close going back, so that's bullish. And I noticed a lot of stuff like pipelines and safety in cash flow, things like that, getting a bid this week. Here's the XLI. I mentioned it in my opening comments, and it's this triple top structure. Look at this thing just bang its head on 79 and not get anywhere, and now it's rolling over, and hard to get comfortable with the price action there that things are going to improve. So not happy at all to see that really kind of breaking down hard. Let's go to the commodities now and just quickly cycle through. Here is the CRB monthly, and we're below my red trend line here. As the US dollar goes higher, it looks like this commodity wants to go lower. On a week, the commodities actually didn't behave too bad. They had a bullish outside bar where we made a lower low and a higher high and a higher close. So this is a reversal, and same sort of price action down here. Now the real question is, does it follow through? What's hard to see is this dotted line on here, and this dotted line is the 20-week moving average, and normally when you're above it, it's bullish, and below it, it's bearish. So we're still below it, so keep an eye on that. And you can see the 10-week and the 40-week, we're below both of those. So far, there's nothing really to get excited about. Now, if commodities were to kind of make a wave right here, this would be great. Conversely, if they roll over right here, this would be just as bearish as it was back in October. which is kind of what I'm expecting based on the way the charts are lining up as a bundle. The DBC commodity index is failing at the 200-day moving average again, so that's just not comforting. Uh, let's go into the individual commodities. West Texas crude is trying to hold above its 10-week moving average, but it's we'll watch for where this wave ends. The other chart I've got later on for West Texas crude shows the 64 level as really being important, and you'll see it on that chart. We really need to get through that, or that's big friction for us. Natural gas is still below its 10-week moving average, albeit marginally higher this week. Heating oil and gasoline both tried to bounce a little bit off their 10-week moving averages. We'll see if they can hold it up. I think it really depends on price action over the next week. I think those charts would roll down pretty quick. One of the big surprises this week was the big shoot up in wheat and corn. Both of them kind of launched themselves up. Soybeans still didn't get a bid, probably under pressure from China. Gold and silver staying below the 10-week moving average and tilting down. Gold actually closed near the lows that we had mid-April, and silver obviously made a lot lower lows. So as much as the charts were trying to set up for a bullish advance last week, they didn't follow through yet. Copper continued to drop, so nothing bullish there. Aluminum was sideways on the week, marginally higher, so might be something there we could keep watching for. Livestock has broken its uptrend. Well, I guess if I use this area, it's broken. If I use this area, it's still holding, but it's right on its edge. It is back below the trend line that had broken prior. Sugar down, coffee down. I feel like I say that all the time on this page. Cocoa down, cocoa up, sorry, cotton down. Cotton really in free fall here, nothing really supporting it. Broke to new 2-year lows this week, so that's pretty ugly. 3-year lows, yeah, really ugly. So lots going on down there, and cocoa just continues to grind sideways for the last year. Nothing really going on. Medical marijuana ETF had another down week, slightly down 1.5%. Full still going below 50. Don't like that at all. Trying to hold above the 40-week moving average. I think if the overall market breaks, you're probably going to expect the marijuana names to get sold off. So I'm watching that closely, but the histogram on the PPO is pointed down. So at this point, still concerning, and maybe this is the place we get a bounce. So keep watching, but until we do, I think caution is in order. I know some of the stocks made new highs today, like Organigram. Coal breaking down hard, steel still pushing down. Even the news on the tariffs today didn't change either one of those charts. Lithium pointed straight down and making new multi-year lows, and rare earth metals is right near the December 2018 lows. Okay, let's go straight down to the energy sector, and you can just see we haven't done anything since the beginning of the month, just consolidated sideways. So while the market has pulled back, these energy stocks have held in there, but they did slide in late April before the market did. Crack, the refining ETF, held in there this week, but still lower lows, lower highs, a higher close slightly. So maybe we get a higher wave here. Watch closely for that. I think that would be one of the things I'd watch for. We can change this trend line now to be something more like that. And so a break back through here, I'd probably get interested. We'll see if that's going to show up or not. But I don't like the way it gapped down last week and is just holding. Full stochastic very weak. Scooter ranking weak. Relative strength weak. Doesn't look like a lot of reasons for people to move towards the refiners. The unconventional oil companies breaking lower. They are down below their 10-week and below their 40-week. The 10-week is under the 40-week. That's a bearish formation. Full stochastic pointed straight down. Nothing good there. And if the PPO is to roll over here, that's a problem. Rolling over below zero, we don't want to see that. And that's kind of back here in 2015 sort of time frame. Okay, this is the chart of West Texas I was mentioning before. Check out how important the $64 level is, and it's really easy to see it when we just have the simple line chart out. But this is an important area, and if we can't get through that, I would expect big selling down on the price of oil. XOP is up here in the top panel, and it's below its 10-week moving average and hasn't done anything since the beginning of the month. The Canadian oil and gas companies have done a little bit better on some political news and on some announcements regarding exports. So that's helped a little bit, but the U.S. side, no change. The PPO is right at zero for crude oil, so if this is going to start to break down, that would be a important place to watch. If it holds up due to the Iran tensions, Venezuela tensions, Russia tensions, China tensions, lots of things going on there to affect the price of oil, but keep watching. Today was a bearish engulfing outside day. Nat gas, nothing really to report. Again, it just keeps grinding here. A break above the 10-week, I think you want to be a buyer, but this week it briefly put up and closed right on the 10-week. So okay, nuclear. I'm not a fan of nuclear, but obviously a lot of people are. This just continues to jog sideways going back to August of last year. No real money to be made. Here is the uranium refiners, or sorry, uranium miners. And what we're watching for here is, can this start to bounce off these lows and push back to the upside like it's done so many times from here? Just range trading it, but you continue to see this drift lower in the highs, so that's not bullish. You have a horizontal line here, a downsloping line here. Usually that resolves lower by about the amount of the top of the wedge, so that wouldn't be good. Okay, that's just the weekly chart of the same thing. Nothing really to look at here. The histogram is still getting bigger. The full stochastic is still pointed down and is below 20. Last couple of bounces have come in this sort of a range, so it's a place to watch if you wanted to. I guess if it made it higher than these two previous closes, that's probably bullish, and just you're out if it drops back below that level. Copper, again, lower lows, lower highs, lower close, nothing really to report other than weak. I showed this chart last week. That's the copper chart, just saying when copper rolls over, it's a pretty good place to be aware of. And copper rolled over a couple of months before the overall equity market did, but here we are back below the 40-week and the 10-week, so nothing bullish here and rolling over at zero on the PPO. Steel. This, I thought maybe with the tariff announcement, as I mentioned earlier, that we'd get some action. This steel chart here is pulling down quite hard, and still no positive price action, and the PPO is hovering right near zero, but relative strength continues to slide, so nothing to look forward to there. Let's go down to gold. One of the things to look at here on gold is this outside week. So we briefly made a new 1-month high on gold this week, and then what happened is we reversed. Not only did we not hold at last week's close, we went right below last week's close, right below last week's low, and closed down there. So that's a pretty bearish interpretation for gold. Nothing that we like. High volume on the selling. With the US dollar breaking out, I'm expecting this chart probably wiggles down. We'll see how it handles the 40-week moving average in green there. Nothing really great to report, unfortunately. Okay, going back to GLD. This is just same thing. The only thing we had the PPO up above zero, and we were watching to see if it could start to turn up. We had some really low volume weeks that suggest, every now and then deep low volume is a good place to look for trend changes. And so the question is, are we going to break down from this low volume or all of a sudden break out to the upside? So looking back on the left here, you can see the chart got down into these low volumes. One of them was Thanksgiving, but we didn't have a lot of volume in here, and then all of a sudden it went on a big ride. So watching the low volume to see which way this wants to break, no answer yet. Silver, this chart just got uglier this week. There's nothing good on it, so it continued to drift lower Support is about 40 cents below here, so down another 1/3%. Silver, SLV, again, gap lower, closed lower on Friday, so nothing good to report there. And if we look at the silver miners, they continue to drift and are now at the horizontal support level for that group. Okay, nothing really that I want to cover off here. Let's go down to lumber. So the big thing on lumber is this outside bar this week, nothing bullish. So we had an outside bar here, actually not quite a higher high, I don't think, but we had a big test of the lows, came up, closed near the highs, made a higher low, higher high, higher low, higher high, and now a higher high, lower low, and closed near the lows. This is a bearish reversal and not very good, and we did have some sort of an uptrend. It doesn't matter how you pick it. Going across like that. This was midweek price action, but the bottom line is we went below all of that, and you can see even just looking horizontally at this 325 level, that's a pretty important support, and if that's not going to hold, I think we've got lower to go, and we rolled over below zero. So unless we get some pretty outstanding price action quickly, this looks like it wants to speed to the downside. The bottom panel here is the ETF called Wood, and this is clearly pushing lower. Here's the 2018 drop, and here's the 2019. We're at lows for 2019 already, and it doesn't look like we're ready to go higher. Not sure that I want to go through all the autos because there's no real positive news there. Ford is holding up nicely, but Toyota Motors actually got smoked this week. It fell down hard, closed right near the lows, and is trying to hold the 2019 lows now, and it's rolling over at zero. This is bearish, not good, and need to continue watching that. But that was a breakdown. This Nissan chart really hard hit. Look at this move this week. This thing dropped $1.50, so 10% in the week, and made new 3-year lows, 5-year lows maybe. Very, very ugly on the chart. So not good news there for the Japanese car manufacturers. And Tesla broke down hard as well, and quite clearly to new 2-year lows. So I think the fact that it tried to rally right in here and it has now failed, this looks to me like it's got a lot lower to go before it's going to be happy. Okay, just briefly to cover off the rest of world markets. Germany, let's go through the weeklies because it's a little better. Germany had a lower low, lower high, and a higher close. So this is a bit bullish because it tried to close near the highs. We'll see what's going to happen here. We don't have any real change of character with the lower low and lower high, but it does suggest watching it closely for next week. And again, this 12,000 level I've drawn on the chart, it's below its downtrend line, and it's holding above the 12,000. So keep watching for which way Germany wants to break. That would be EWG or HEWG to see on that front. Here is the French market, and it had the same sort of trade where it was a lower low, a lower high, but a higher close, and it bounced off the 10-week moving average. So that was pretty bullish. That was the good news. Again, we're still jogging sideways here, so we don't have a feel for direction, but everything seems to be rolling over. Look at the full stochastic tilted right over. And the PPO is now starting to move down. With this price action, it did slow the move down momentum, but we still don't have anything that makes it a buy signal yet. I mentioned the Swedish market right at the very front here, and it made a lot lower low, a lot lower high, and closed marginally above last week. So I don't get the feeling that the Swedish market is telling us to get all bullish here on Europe. The Shanghai we covered off, the Nikkei we covered off. Let's go to the Australia market. This is really interesting. So the Australia stock market soared on a weaker currency, you can see a big outside bullish reversal here where you have a lower low, a higher high, and we took out the prior high, so that was nice. I don't know if we took out this one. But the real question we have here is we closed right up near this previous high close. So next week will be one to watch for Australia. Does it start to break out to the high side? Brazil put in a weak candle this week, came down hard, making new 2009 lows and finishing right on the 40-week moving average. So not a lot to support there, and the 20-week clearly below. So again, the sentiment we saw in the emerging market currencies really hit home. Looking at Russia weekly, it did okay this week, and I think that might have been on the news of the oil prices, but lower low than a higher close. So an outside week and closed up near the top and well above the previous 2 weeks, so that's pretty good. Whoops. The one thing on the S&P 500, I think just standing back looking at this chart again, everything's starting to roll over here. We're making a lower high on the relative strength. So this is pretty cautionary. I think I've laid it out before, but if we can't hold up in this 2850 level, this is a pretty big deal. So important week to watch because we're starting to make lower lows and lower highs. I did cover off on my Chart Watchers article this weekend, and we could just go see if it's published. Let me go try and grab that for you. I don't see it there, so let me go here. And the point I want to make is all of these bank stocks are starting to look very weak. This is the KBE for the US market, and rolling over below its 10-week and 40-week to finish, rolling over right at zero. This is bearish. Full stochastic starting to break down. Scooter ranking falling apart back below 30 or at 30, so that's a problem. But I put in some links to all these other charts, and here's the New Zealand bank chart. Australia, New Zealand, ANZ, or ANZ. Anyway, downtrending for a couple of years now, but look at this breaking to new 2009 lows. And the other problem with this break to new 2009 lows, it's marginally above breaking to new 3-year lows. So just think about how far the S&P has moved up in 3 years, and here's a bank going the other way. Now, if it was only one bank, that wouldn't be a big deal, but the concern I have, just rolling through these charts with me, is that these charts are breaking hard. So here's another Australia chart. Look at this one trying to break to new 5-year lows. It's just got the brief stab in December below it, and other than that, it is new 5-year lows. So those two banks don't look very supportive. And here's 3 Japanese banks that are also starting to break down. So this Sumitomo Mitsui making new 2009 lows or very close to it. All of these things rolling over below zero, this is not good. And again, I think when you have world weakness in banks, that's a problem that we need to be cautious of. Here's Mitsui Financial, and it looks like it's breaking to new 3-year lows or very close to it. Definitely 2009 lows, and not very much to go to get below the 2016 lows. Sorry, mixed up a little bit here. And then there's one more Japanese bank. So my concern is, what's with all these Japanese banks breaking to new lows? And this one's actually taken out its 2018 low already. So you think the stock market way up here, and this bank is breaking to new lows. That's a big problem. Rolling over near zero. And, it's not just Japan. It's not Australia. Here's Deutsche Bank from Germany, and you can see this one actually did make new lows, and this goes back to 16-year lows. It's well below the 2016 low. So we've got lots. So things are really breaking down here, and I think it's the global weakness in banks that we need to worry about. Thanks, everybody. Bye-bye.